Yo guys, what's up? Good morning. Today's Friday, August the 28th. Last market trading day of the week. Should be a spicy one, as we have Monday to finish off the monthly trading. Just one day after today, one market open in the week. So looking forward to that. Today we're gonna take a look at Fibonacci. Fibonacci. What can it do for us? Why do we use it? Why do people talk about it? We're back in the trading palace to continue for our third episode in a row, taking a look at some basic trading fundamentals. And today I've chosen Fibonacci sequences, retraces, etc. Very commonly used term, really in all markets. So what is Fibonacci? Fibonacci is a 1,000-year-old high school textbook algebra equation. And basically what it is a sequence of numbers that we see appearing in nature, appearing really in all things. Man, that font is smaller than I thought. Let's zoom it in. Okay. So Fibonacci is actually very intuitive. The sequence starts with 0, 1, and to derive the next numbers, you simply add the previous two numbers together to get the next. So 0 plus 1 is 1. 1 plus 1 is 2. 1 plus 2 is 3, so on, so on, so on. This sequence was originally used, I believe, to calculate the rate of rabbits breeding. I don't know. But what it really is it's just a fundamental ratio. We derive the golden ratio from it. That is in everything. They're very intuitive numbers. They're very easy to understand, and so logically, in trading, we see value in this as well. So something that's actually pretty interesting too. Now I'll just go into this because I'm a math nerd. Is that there's a lot to this. When this was first pioneered, I'm sure this wasn't on their radar. So what we see is, if you take the squares of Fibonacci, I'll just do these ones. If you take the squares, you find, so the square root of 0, 0, square root 1, 1, square root of 2 is 4, 1 plus 4 equals 5. Square root of 3, 9. The square root of 2 is 4. Add this together. 4 and 9, 13. Square root of 5, 25. Plus 9. 9 plus 25, 34. And yes, that continues out forever. You just keep doing those. I find that fascinating. What appears to be a simple set of numbers has a ton of complexity. I wouldn't have assumed that if you take the squares, you would find a repeating pattern as well, but that really fits the MO of Fibonacci. It is, I would put it in my own terms as it's a sustainable set of growth, maybe for organic life. A few examples, you really can see these everywhere in nature, such as flowers, petals. The amount of petals they have is almost always a Fibonacci number. This is the Fibonacci spiral. You may have heard of that. It is really that same concept. Each number created by the sum of the two previous in a growing pattern. And it tends to create very balanced structures. Possibly why we see it in organic life. But then there's things that don't really fit that mold. Giant storms fit the Fibonacci curve, or Fibonacci spiral. Nautilus shells, this one makes a little more sense because it's building, it's an organic growth. These spirals are everywhere. So they seem to be fundamental, maybe not just to life, but to the universe. Speculate all you want on that, don't know. So how can we use them in our trading? The most common use of them would be Fibonacci retracements. What is a retracement? It is a correction in price, a temporary reversal, basically a move against the trend, and those can be very valuable. Those moves against the trend can be great positions to go long or short, and we'll try to use examples for both here. So in an uptrend, when a trend is clearly moving up, and this is what we'd want to identify before we took out our Fibonacci superpowers. So in an uptrend, we have a move up, followed by a pullback, then continue the trend. In a downward trend, we see the trend moving down, we see a rally, and then we see the trend continue. So what we're going to do here is we're going to look at ways that Fibonacci might be able to help us identify both rallies in a downtrend and pullbacks in an uptrend. A little more base knowledge for you. So Fibonacci tool on TradingView, if you go to your tools on the left, you will see this crisscross confusing looking icon. It says XABCD pattern. If you click that arrow, wow, did I really just do this wrong myself? No, I'm right, isn't it here? Man, starting this day off weak. All right, my bad. So right underneath the trend arrow, you can't see it on the stream because of the music conveniently in the way. There's a little pitchfork, that's what I meant. Fib Retracement Tool. Click that and you'll be able to make these fancy fib lines. But first we're going to talk about fibs in general and how to use this tool. So there are actually 1, 2, 3, 4 fib retracement levels. There is 0.5, and they say that 0.5 is the most common retrace, 50%. 0.5 is not a Fibonacci retracement number though. It's really just cutting hairs, like what is considered is and isn't. Not super important, but if you ever want to sound smart and someone says 0.5, that's not actually a fib. So what we do here, in a clear uptrend, we want to identify two things before we even touch our tool, and that is the swing low and the swing high. Doesn't matter what market, doesn't matter what time frame you're on, it can be applied really universally. So a swing high is simply a high point of a local trend. The swing low is simply the lowest point of a local trend. So you might see something like this. Swing low moves up to the swing high, and then you see what could be a pullback. You start to see the trend reversing at all. It's not considered a pullback, or at least a fib retracement, until it hits 0.786. This is considered a shallow retracement. 618 is the golden retrace. People very often talk about that. Some of the strongest reversals can be caught in this area. 0.382 is called a deep retrace, and a 236 is the deepest. Under that, you only have your swing low, which would imply if the 236 is broken that you're likely doing 100% retrace, or we'll get to this later, well, pretty soon, a a full retrace and a retrace extension. So when looking at a bullish trend and trying to apply Fibonacci, we're going to look for a high point, the swing high, to pull back to at least the 0.786. Now, to use this as the textbook term, I guess we'll use it. They say 0.5 is the most common retrace, so we would see perhaps the trend finds support at 0.5, and it's not advisable to look for a position there because that's really just guessing. Ideally, we would want to see the pullback to 0.5 and then a break back up of the 618. And if you consult a boring textbook expert on trading patterns, they would say the re-break of the fib above it would be the time to look for a long, to enter a position. So fib takes a little bit out of the catching falling knives kind of concept where you're just maybe buying randomly. We'll look at some examples today. We'll try to apply this. But what you'll see once you start looking for it is almost every move on every market, whether it's up or down. Now, you guys hear me say this a lot. There's red and green in every trend. It's never just one or the other. And so this is a great example, or this is a great tool that proves that is even when something's going up, it still has these movements back. And 0.5, so say something starts at $0 and goes to 100, the 0.5 pullback would be 50. There's many reasons this could be. It's all speculation. I would say one, it helps take out positions. People, when they see this swing low and they start to see it climb back up, people start taking positions. They start FOMOing in. The higher it goes, the more they FOMO. And when you see that correction or that retrace begin is when people start taking profit. People that made positions on the way up start taking profit. And these fib lines, I think, are powerful because they're logical, kind of easy to understand places where people would then want to enter again. So say somehow you bought something at 0 to 100 situation. Someone bought something at 0, they decided to take profit at psychological 100. Price pulls back to 50. That's a 2x. They've doubled their position if they rebuy it at the 0.5. So it's just like a logical. You don't really need to understand math, especially to understand 0.5. It's like a doubling. Very easy. Let's look at it from a bearish trend. So in a bearish trend, we would be using it the opposite way. You'll notice that swing high now has the 0 and swing low now is the 1. Did I do that backwards? I don't think I did. I did do that backwards. Ignore that. Don't look at it. I'm not sure how to fix that on the fly. Either way, the 1 stands for 100. So man, I messed that up, but that's okay. All of this still applies. The 1 stands for 100, meaning 100% retrace, meaning price has returned to where it was. So really, I did that backwards. All those numbers should just be flipped. We can keep going though. I'm gonna show it this way. So really what we just looked at would be like this. And then this would be the position people would look to take along. Man, I goofed that up. I spent a bunch of time setting this up today. Whatever, yeah. It all works out. So let me actually go back to do the swing low. Here we go. So we, in the bear situation in a trend, we look at the swing high to move down to a swing low. People take profit on their shorts. which pushes price back up. 0.5 is the most common area where that will retrace half of the gains. And if, according to the textbook, in a short situation, the entry would be on the break of the 0.382 after the 0.5 acted as resistance. And what's very nice about this for trading as a cookie cutter kind of, I don't want to say one-minded, but taking out a lot of the noise again, because you're just looking at patterns, percents, is this sets up an easy area to have a stop loss. So if the 0.5 retrace showed itself as resistance, logically at the 618 here, you could use that as a stop loss potentially, because that would invalidate what you're looking at if it broke up above it. And so this is just one half. This is the retracement side. So there's another element of Fibonacci, the Fibonacci tool, especially in TradingView. There is retracement and there is extension. So extension is the more interesting part, in my opinion. That is how you guys have seen me pick out targets for coins that don't have any trading history at that price level. And it uses the same logical, easy to understand concept of people enter trades, and the more successful that trade is and that trend is, the more people jump in. And then those people are all in the mentality of taking profit, locking it in, and there's going to be a self-fulfilling prophecy there. That's a big part of these Fib levels, is that people look to take positions on them. And so they do tend to kind of enforce themselves. So Fib extension. So say we saw in the bullish situation, our swing low, move up to our swing high. That's when we would be able to place this Fib tool, which I already have up, but I will pull it out again for you guys. You can see these trend levels or Fib levels scale out with where I move the mouse. I already have one placed to make it easy. But say we saw a sell-off, 0.5 acted as support, but wasn't enough, and we come all the way down to our 1 level again. So that's 100% retracement, meaning all of the movement, all of the gain or loss, depending, was lost, and we're back to the 0 level. We can use these Fib extensions, which you see are lower, and they're calculated the same way. Instead of 0.236, 0.382, 0.5, 0.618, point whatever. I don't know how to make them bigger so you guys can actually see it. I'll just read them to you. After the 1, we see underneath it 1.272, 1.414, 1.618, and so on. Then 2. I have these set up custom so that the 2 and the 618 are green, and that the 0 is red. And that's just my personal preference. The 1 is yellow. It just helps me identify without trying to read these tiny numbers when I'm charting at what level we're at. So common extension levels. So we had this scenario where we had a swing low and a swing high, and then retraced the entire movement. Where we would look then is down at these extension levels. The ones that I use a lot is the green here, the 2. Move this over. The 2 level is very common. If I were in this position and I saw the 1 or the 100% retrace break, I would look to short to the 2 with an extension target of 2.618. And no, it is not likely it would be a straight line down like this, but that's how I've figured out these targets in areas where we don't have data. I think it looks better on the way up. Okay. Let's throw it on something. So this is Bitcoin on the 4-hour, very mashed together. And so here we can take a look using this tool. Okay, so August 2nd, August 3rd, 2020, we had a big sharp sell-off. And so we can identify the top of that as the swing high and the bottom wick of that as the swing low. So remember, when we placed this at the time, this is all the chart data we'd have. We wouldn't have any more. We saw on August 10th almost 100% retrace of that sell-off, which indicated that perhaps we should be looking for a fib extension target above us. And you can see here on August 17th, it's not perfect, but very close, within a percent or two. We saw a move up to the 1.272 extension. So this fib tool gave us this target of 12,571 with pretty good accuracy. This might not be the best example. I didn't plan this one. I just picked the first thing I saw and threw fib on it. But what you'll see is no matter what time frame you're on, these levels almost always show some kind of price action influence. So we saw a move up to the 618 here, almost perfect. And then it was rejected back to the 382, up to the 786, back to the 618. Like these levels are everywhere, all over charts. That's a really good example. I know I had a really good one. Might have lost it. Not good. That's okay. Use this. So we really can just pick anywhere on the chart and try it out. So we have a swing low on August 11th. Lost my tool. Swing low on August 11th. Swing high on August 17th. And in this randomly picked situation, we do see 100% retrace of the move. I'll go up, pull back to the 618 right here, and then we had a fake out, which came back down to 786, then a fake out back to the 0.5, which sold off for 100% retrace. These levels aren't going to be to the penny. Like they never work that way, in the sense that you can say it'll be exactly $10,614.23 or something like that. They're just very close. And so what the textbooks say is when you hit, so say right here, this is the 0.5 retrace. It breached it, so this is a 0.5 retrace all the way up to where the 0.382 begins. So if it doesn't actually breach this price level, this is still a 518, and that gives it a little more leeway. Or not 518, a 0.5. I'm everywhere today, man. I did a lot of sleeping yesterday, and my brain, I think it's still sleeping. So these areas are more like zones than they are exact prices. But because of the nature of them and of the zone, it allows us to look and identify potential entries and stop losses. And with our extensions, we can potentially identify future targets that are beyond the swing high and swing low areas. So I kind of want to pull up something random because I lost my good example. Let's look at gold maybe. Gold probably is a good one. Well, we're going to find out if gold is a good one anyway. So let's see. Right here on 3rd of March in gold on the daily. Let's throw Fib. And let's see if we can't find a target that agrees with it. So this is pretty dang good. We had our swing high into our swing low. We had the full retracement right here. We broke the entire retracement, suggesting that the trend is still going to continue in that direction. And we see it come up to 2.272. Of course, it's not exactly on, but that's dang close for not having any of this chart history at the time. We don't have any of that. We put our Fib tool and it gave us a target that was very, very close to where this topped out recently. That's really the power of the Fib tool, in my opinion, is that when you don't have anything to use, you don't have any chart history, I think that's when it's most valuable with the extensions. But then it also, with its retracement values, gives you a lot of value on short scalpy, like kind of short-term scalp plays. So when we saw gold sell off back here in 11th of August, we saw a wick indicating this could be a swing low, and almost every single swing of price retraces to that 0.5. So as soon as we saw this daily close and we saw this wick, we could have easily tried to take a position. So a daily close right here. We could have tried to take a position back to the 0.5 because that's the most common retrace. And look, next day, right back to it. Just using those fibs, that would have been like a 3% play. Pretty powerful. You see, you're really gonna have to take this tool and just randomly apply it yourself to see really how close price does follow it. Almost every move up is followed by a move back equal to half of the move up. Every move down, you almost always see a move back 50% of what was lost. And so what that creates is really just that kind of peaking up down pattern that we're used to seeing in charts. Fits pretty well. All right. So I think that's probably it. That's probably it for me on fibs today. Fibs are a great tool. They're not necessarily my favorite, but I think that they have a place and a time where fibs are really excellent tools to use.